involved in investing, managing other people's money, research, advice, my entire working life. I used to work in an industry where the data was plentiful, and then moved into an industry where there wasn't much data at all. And now, all of a sudden today, we find that it is now plentiful with data. But what people don't know enough about are the big megatrends. So we hear about these megatrends, but we don't know what they mean for property. And so what I thought I'd do today is try and take some of those big megatrends and then bring them down into Melbourne, into a space that we all know and understand and recognise. So we'll whip through that in about 20 minutes, and maybe if you've got any questions, write them down, and we can rip into some of those questions afterwards. But I thought about the audience today, and I thought about the age group of the audience, and I thought, right, I'll pick something that might just ring a bell with you all. So I want to kick off with Bob Dylan first up, just to try and set the scene of what it is I want to talk to you about. So this is a cracking good song called All Along the Watchtower. It was eventually covered by Jimi Hendrix and was a #1 for him, but Dylan wasn't very famous with it. But this line in the song really struck with me, and it struck with me my whole life, because whilst we sit there and we look at the world around us and we can put a value on things, whether that's shares or property or bonds or any of the things that we might value, from bottles of wine to clothes and holidays and so on. This difference, this concept of worth, just because we can value it doesn't mean we understand what it's worth. I was an equities analyst for many years doing oil, coal and gold companies. And yeah, I could value it, but that wasn't what it was worth. Not even its share price told me what it was really worth. So I want to get into this concept of value versus worth, because it's a difficult one to get around, but it's what we invest in. Yeah, we all talk about value, but let's get into what it's worth. So here we are, the Dutch, 350 years ago. They were big traders, and big traders in spice, particularly through Asia. And there was this set of islands, 5 islands in Indonesia, what is now Indonesia, and they were the only source of nutmeg on earth. You couldn't get nutmeg anywhere else, just there. And the Dutch wanted a monopoly. So they traded it with the British for an island that had nothing, no present value at all, zero. And the Dutch called it New Amsterdam. And of course, today, wind forward 350 years, and the island of Run Palau, you're lucky to find it on a map. And it's a worthless piece of real estate, because we all worked out how to grow nutmeg elsewhere. And so the value of nutmeg now is not particularly valuable at all. But New Amsterdam became New York and is now home to the most valuable real estate on the planet. So it's time, its value, and its worth. So let's have a look at Melbourne. Let's wind the clock back, not 350 years, just 160 years. 75% of the population lived in the countryside. Just 23,000 people here in what was then metropolitan Melbourne. Now run it all the way forward and we've flipped it completely. 75% of the population live in metropolitan Melbourne. So if you'd seen this trend coming at any point in time there, you would have been ahead of the curve. Out of farms into metropolitan. Out of rural communities into cities. And this is a trend that's happening all around the world. But this trend investing, it's not about what it's worth today or its value today. It's where is it going? And so working out what the big mega trends are and where Melbourne's going is a big part of being a successful investor. Right, this picture here, some of you might recognise it just straight away. That's not that long ago. Melbourne, that's the top of Collins Street, so just up the road there. A little boy standing there on a horse-drawn carriage, dirt. Look at the houses there. Let's run it forward a few years. Yep, still horse and carriage. They've built a 3-storey building on the corner there, you notice. Let's run it forward a bit longer. Little boy's back again. But look at the house on the corner there. That's a new one. The 3-storey one is still sitting there. Tom Roberts, the painter, was living in that building on the left-hand side there, the famous Melbourne painter. Run it forward a little further. Oh, now we've got trams. We've still got the horse-drawn carriages though, so technology still hasn't come in quite yet. And then run it through to today. And look at that house, it's still there on the corner. So some things, regardless, still stand through time. And if you'd kept that in your family for all that period of time, what would it be worth today? This is about long-term investing, generational investing. Now, a house in Broken Hill would have gone all the way up and come all the way back down again, because the mine doesn't last forever. You have a look at Melbourne here in the 70s and then run it through into the 80s and then up to where it is today, and you can see the density starting to increase. Look at Flinders Street, where it was in the 50s and then through the 80s. Here it is, and some of you will remember the Allen's Sweet Shop, the factory there, and all the factories through South Bank there in the 1970s and 1980s. You can see the MCG sitting away over there, no southern stand yet. There's no tennis centre, there's none of that amenity built through there yet. And then you run it forward to today, and you can see the changes there over time. Quite a substantial shift. Now, technology drives that because we can get taller buildings. And so the intensity of the land use drives land values up. Here we see Melbourne almost from Docklands there, and then see what it is today. The density is continuing to increase. So if we run that through into some of the big trends that are coming into the future, all around the world, jobs are moving in from the suburbs into the inner city areas. Now, the inner city area is about a 10-kilometre radius from the CBD. So there's huge opportunities presenting themselves, not just in the CBD itself, but in all the surrounding precincts. And to be honest with you, as the population continues to grow in Melbourne, the opportunities are going to be rather overwhelming. But sites and buildings are being converted to residential, and we'll look at that in a little more detail. But part of what's going on is our working lives have gone from that 8-hour day back to a 17-hour day. And it's a bit of a shame, I suppose, because a lot of people fought really hard to get that 8 hours work, 8 hours rest and 8 hours play, and yet we've allowed that now to morph into this 17 hours where we intertwine all of that. And so what employers are looking to do for their productivity gains is to get people closer to work, rest and play, to have them closely integrated so that you can move seamlessly in and out of that in a day. And think about it, your phone does it for you. You wake up in the morning, it wakes you up in the morning, you grab it, you have a look at it, you get on with a few emails, you check a few websites, and then you set about your day. And the last thing you do at night is you put the phone down on the bedside table. And so that is extending our productive hours in a day. And so our built environment is doing the same thing. So the things that are important into the future are these 9 things. And Steve's touched on a few of them with that move into the environment. There's not much of a future in a built environment if you can't breathe the air. Culture's a big deal. Having a strong, vibrant culture. Not just one, but multi. And Melbourne's got that in spades. Transport, how we get around now, but how we get around in the future. Drones, driverless cars, walking, bicycles, not horses. Health is going to be a really big deal. The Western world, in Australia, has an ageing population. But the advances that are coming in health and health sciences are going to be quite revolutionary in the next 20 years. Being connected within Melbourne, within Australia, and of course with the rest of the world, brings the world actually much closer together. There's now 6 billion mobile phones on the planet. People are more connected than they have ever been. Education's a big deal. Melbourne's the 3rd biggest international student city in the world, behind London and New York. Not many people know that. The growth in education in Melbourne has equalled the growth in IT&T from 1987 to today. That's growth in employment, growth in floor space use, any measure you want to have. And that's quite extraordinary. Energy is going to be a big deal, how we power our cities, how we invest in that. So when you look at these 9 on the panel here, transport, health, education, energy and water, it's all infrastructure spending. And there's going to be more of that. And as we get more infrastructure spending, it attracts more people. And more people means more infrastructure spending. So it's a positive virtual feedback loop for property. Some of the bigger trends that we see, the population growing. Now, whether you agree with Dick Smith or not, regardless, our population is headed towards 35 million people. And the people that we're bringing in are the creme de la creme of the skilled people on the planet. And we're not like America, who needs 100 million. We only need 8 million. So it's very doable from an Australian perspective. That increases our IP, our brain space as an economy, and makes us a more innovative economy. It also brings in more taxpayers, which helps fund everybody's retirement and healthcare needs into the future. But then that means there's demand for houses. And we see that in Melbourne and Sydney, where we're finding difficulty in building enough houses for everybody. And so there's going to be a lot of solutions there. And as we bring in more people, that means more jobs. And we're growing jobs at a huge rate of knots. Last year in Australia, we created 400,000 jobs. So even with people retiring, we're still creating more jobs. And they're new jobs.
When you look at what we're seeing in the capital markets, we're seeing unprecedented liquidity for Australian commercial property. Headline transaction volumes last year was the 3rd highest on record. There's a few things that I want to do through my career, and I'm conscious that researchers don't necessarily leave legacies. We like to think we do, but we probably don't leave the same legacies that people that build product, that create product and manage that product. But one of the legacies that I would like to do is to change some of the vocabulary in the industry. And nothing frustrates me more than hearing a building is trophy, iconic, unique, rare, or landmark when it's none of those things. The other thing I would like to see a little more discussion around is the argument around the weight of capital. I think if you pull your chest out and say, oh, it's the weight of capital, you can just about say anything after that statement. So what we've tried to do is actually quantify what that weight of capital actually means. So we look at it in a more micro sense. So we went through every transaction JLL was involved in the office sector, over 100 million. And for every dollar of product that we offered, there was $6.3 worth of capital actually for that product. Now this is not inspections, this is not registrations of interest, this is actual genuine bids. So to me, that starts to give you an insight into the weight of capital type argument. And that was obviously greater in Melbourne and Sydney than what it was in Adelaide, Perth and Brisbane, so that's an aggregated figure. But when you're looking at the core markets, that figure, as I said, is clearly quite a bit higher. The other point around the weight of capital argument, which I think needs further articulation, is the longer term trend of the why real estate argument. Now, I'm not going to spend here the next 10 minutes and talk about the pros of real estate because we all clearly know that. But we look at what big sovereign wealth funds, what pension funds are doing around the world, and generally, most of those groups are increasing their allocation to real assets. So there's more capital to be deployed into the sector. The other big trend that we see is a geographical tilt towards the Asia-Pacific region. Now, if we sit here today and look across Asia-Pacific, 26% of the global real estate investable universe is in Asia. Over the next 20 years, we're going to see stronger asset creation. Generally, values over the longer term are related to inflation, so we've got higher inflation economies. By 2036, Asia-Pacific is expected to represent 43% of the global investable universe. And we're seeing a number of pension funds out of North America and Europe in particular that are thinking around that from a geographical asset allocation perspective. The challenges we know when they come to the region is they're ultimately looking for transparency. They're looking for low volatility in their real estate. They're looking for low beta sectors. So a disproportionate amount of that capital is being deployed into Australia and Japan. So we think that's the two big themes that support the weight of capital into the sector. The other question we get asked a lot around what's happening in the investment markets is how much are offshore investors participating in Australia? And it's actually quite a difficult question to answer, because if you look at someone, and apologies Steve, I don't actually know the CHC number, so I'm going to have to use Dexus. You know, 58% of the units in Dexus are now held by offshore investors. But when we account an acquisition by a Dexus or a Mirvac or a Charter Hall, we would call it domestic. But we know there's offshore capital sitting behind that. On our own direct numbers, it's about 35% of transaction volumes over 5 million over the last few years that has been an offshore capital source. But when you look sector by sector, you get some very significant divergences. The office sector is about 50%. Retail is about 12%. So some of the bearish sentiment towards that middle part of the retail market is very much reflected in offshore interest in that sector. And logistics, and I actually had quite a few images around logistics, because as Steve knows, I'm an office guy by trade, but I've suddenly got very fascinated by logistics as a sector. And I'm really interested in what's happening around the globalization as an asset of that asset class. And it's now 30% of Australian logistics facilities are acquired by offshore capital sources. So I think there's a really interesting story around there. And when you think about logistics as an asset class, you have to start with e-commerce penetration rates. Euromonitor state that less than 8% of retail sales in Australia are online. If you look at other mature economies, that's anywhere between 10 and 14%. So the one thing that we know with a level of comfort is Australia will rise and it will be positive for the logistics sector moving forward. The logistics sector, in terms of its evolution, in terms of product, in terms of location, has all changed significantly as well. So if we look at what's happening in logistics, and apologies, because I've been talking, I'm just going to cut around this presentation rather than go through in order. Now, I've fixated on Amazon here. Clearly, I could have fixated on a number of different groups, but Amazon have a lot of transparency, a lot of information around what they're actually doing in terms of their fulfillment centers and their warehouses. Does anyone want to take a guess, if you look at the top 20 fulfillment centers that Amazon has in the US, how many robots they have working in those centers? What do you think, Steve? 600. Now, I'm disappointed because I delivered this presentation a couple months ago and Steve was in on it, and he clearly wasn't listening to every single word I said. So I'm putting a little black mark against your name there, Steve, but 44,000. Now, again, you have to look at the definition of robot in terms of how wide that is. 44,000 robots across 20 fulfillment centers that Amazon operate. And the backbone of what they have is what used to be the old Kiva up there in the top left, which was acquired by Amazon in 2012 and renamed Amazon Robotics. And it's fairly simple technology. It works on a warehouse management system. There's markings on the floor in terms of how that moves product around the warehouse. But what I like about groups like Amazon and other e-commerce type groups is their commitment to continual improvement. They have the Amazon picking challenge, so they continually challenge their engineers to come up with new and innovative ways around their internal and the improvements on their internal supply chains. And then, and Tony touched on it earlier around drones, where there's a number of articles about, there was an article yesterday, and Tony might correct me on it, but there was around the congestion that we see in cities and what proportion of that is essentially a car looking for a car spot. And that's a modern problem. But when you think about driverless cars and you think about other evolution in transport, that modern problem may actually disappear. And a lot of building owners are going to be sitting there going, what do we actually do with our car parks? And one solution is ultimately those car parks become fulfillment centers because they're very close to very strong population growth corridors. But if you look at what Amazon have developed in terms of their Amazon Prime Air, now they've got 5 research centers across the world dedicated to this technology. They've got one in the US, one in the UK, one in France, one in Austria, and one in Israel. They will make the technology work. It's more a discussion around the regulatory piece in terms of how that evolves. So apologies, now back to a slightly more boring, classic sort of property researcher chart, which just looks across each of the markets in terms of what we're seeing. Now this is development activity, but if you take Sydney specifically, 15, 16, and 17, we saw over 1 million square meters of take-up. When you look at the development pipeline, you can clearly see there's a disconnect in terms of the amount of product that's being delivered. When you look at this development pipeline specifically, it's 75% pre-committed. When you look at Melbourne, you see similar levels at around that 70% mark. So what's been expressed in the sector at the moment is around land values. Land values in Melbourne's west over the last 12 months are up about 16%. Land values in Western Sydney are up about 30%. And we think this is interesting from a rent growth perspective, because while we will see some modest yield compression, the bulk of yield compression has already occurred. The bulk of the efficiencies that you're able to generate in terms of importing materials from China, in terms of the construction of these facilities, has already occurred. So with the increase in land values that we're seeing, that will manifest itself in cost push inflation, and we will start to see an increase in pre-lease rents in both Sydney and Melbourne. Now, I might briefly touch on the office sector and come back to a slide earlier to finish up on. But when we look across the office sector, and apologies for a lot of numbers on this scorecard, but it gives you a flavour of where we are at the moment. As I would have said in my opening text slide, Sydney and Melbourne are 2 of the strongest office markets in the world, from an occupancy perspective and from a rent growth perspective. When you look at the vacancy profile over the next 4 years, it remains very low. Sydney's development pipeline continues to be pushed out. So by 2021, our expectation is still around that 6% mark. Melbourne, as we know and we can see in the sky, there is a lot of development activity delivering in 2019 and 2020. This is demand-led development activity on the back of some of the numbers that Tony was touching on. It's about 70% pre-leased. We do expect to see a slight increase in vacancy, but if you look at the long-term average for vacancy in Melbourne, we would say equilibrium's somewhere between 7 and 9%. So a figure of 7.9% when we go through a very significant development pipeline in 2019 and 2020 is still a very healthy market. Now, I can't remember if Steve told me that there was going to be anyone from the media, so I'm not going to look at him while he answers that question. But one question that we've been grappling a lot with is looking at long-term growth rates. Now, I wasn't actually going to put this slide in here because I'm very nervous around unpublished research and what that actually means. But if you look at the average rent spread between Sydney and Melbourne on face rents, it's about $500 a square metre on average. That's as wide as it's ever been. So let's assume that that $500 remains constant over the next 10 years. And let's assume we've got our Sydney growth rate right, because Tony will tell you researchers have never got their growth rates wrong. We're always 100% accurate. So we're fairly comfortable there. What do you think that back solves as a growth rate for Melbourne, Steve?
10, 12%.
You're getting towards 6% per annum for the next 10 years. Now, clearly that's not our published house view, but that's the role of analysts and managers, is to actually look at that relativity between markets, to look at mispricing, and ultimately price can change behavior. So we certainly don't see organisations saying we're going to move our headquarter from Sydney to Melbourne, but we do see organisations saying, well, actually, we will move part of our operation because Melbourne has, we talked about the student numbers earlier, great universities, well-educated people. It's got the most livable city in the world, according to The Economist, for 7 years in a row. There's a lot of very positive features around why organisations would grow part of their organisation here. So we think that while we have a published view around growth, we think there's some scenarios that you should actually be thinking about in terms of what could actually play out. Then you've got the other markets in terms of where they're publishing their vacancy rates at the moment. And when you look across Brisbane through to Canberra, you would be looking at that and going, those markets don't look particularly healthy looking at those headline numbers. When you look at those markets, you have to read behind the headlines. Brisbane prime grade vacancies now come into 8.5%. It's the lowest level in 4 years. Secondary grade vacancy is sitting at 20%. If you look at Canberra, I call it the 5 to 25 spread. 5.5% for A grade, 25% for B grade across that market. So while analysts like myself are very guilty at putting up sort of headline numbers, you always have to read behind the numbers. I mean, if you're in Civic and Barton looking for A-grade space of 1,500 square meters, you've got about 4 options. That's why you're seeing rental growth in that part of the market, even with sort of numbers sitting at these levels. The other interesting point I took from Tony's discussion was around population growth and density. And admittedly, this is more of a Sydney story, but we're very positive on metro markets in New South Wales, partly because we believe that organisations are now looking at going back towards what was the old hub and spoke model. So for a long period of time, organisations said, we have to have everyone in the same space. That's how we're efficient. That's how we're productive. The reality is it doesn't work for people. So we're a believer in the emergence through infrastructure, through change in demographics, through change in amenity, in some significant growth in some of the metro markets. And the one that I really want to highlight is Parramatta. Now, everyone in this room has probably heard someone at some point in their career say something good is happening in Parramatta, and they're probably thinking they were wrong every single time. This time it feels real. The commitment is there around infrastructure. If you look at the demographics of the city of Parramatta, 37% have a bachelor's degree. Across Sydney, it's about 22. So this is a highly educated workforce. And every time I go out there, I do the old residential thing. I look for the new cafes. I look at the quality of those. I look at where I park the car, and I look how much further I am away from the office. So it's that residential real estate thing that you can't apply it to commercial, but you see those signs happening before you. We're of the belief as a house that Parramatta today is about 720,000 square meters. By 2022, it will be a 1 million square meter market. It's going to be a market with a lot more scale, depth, liquidity, and then you start to think about relativity in terms of yields and pricing moving forward. The analysis that I touched on for Melbourne, you could actually do for Parramatta as well. The spread between Sydney rents and Parramatta rents has never been wider. Now, if I can, I might go back, because I think there's 2 charts earlier which I didn't touch on that I think are worth highlighting. The first is just looking at yields. Now, we can talk about the search for yield. I think we're all a little bit over those sorts of phrases. I went through a period where I actually used to keep them in a notepad. So we had the search, we had the hunt, we had the thirst for yield, and my personal favorite was the yield famine. So I was keeping these basically through articles from Bloomberg in terms of how many ways could you say the same thing. The reality is, in a low growth world, low inflation, lower interest rates, yields for risk assets move down. If you look at these numbers in isolation, you'll see that they're now tighter than where they were in 2007. The reality is, though, you can't look at yields in isolation. A property yield is ultimately the function of the risk-free rate and an appropriate risk premium. So in this graphic here, we're looking at the spread between the yield and the inflation index bond rate. And while that spread has compressed since 2012, you look at the office sector as an illustration, it's still 125 to 150 points higher than where we were in 2007. Now, as I said earlier, we think we've had most of the yield compression cycle. There's a little bit of yield compression depending on the sector or geography. But what I take comfort from when I look at this slide is, given where the risk premiums are, is when we do start to see a partial reversion in bond yields, Australian real estate can absorb that. If we were sitting here in the US or France or the UK with the same chart, we would be sitting there going, there's no spread to those historical relativities, and we would be very nervous about the impact of rising bond yields on asset pricing. Pretty boring chart here, rental growth. Tells the sort of story that we know Sydney and Melbourne markets are outperforming. If you look at our projections for face rent through 2021, in Melbourne, we actually have Melbourne as our top pick over that time period, followed by Parramatta. The reason I'm using face rents is we report face rents for the logistics sector rather than effective at the moment, so it's a like-for-like comparison. If you assume a reduction in incentives, then clearly you're just pushing those numbers higher. But generally we believe, even with the strong years that we've had, lower vacancy, competition for space, that we are in an environment of upward pressure on rents. When you start to look at some of the weaker markets, such as Brisbane and Perth, clearly you're not seeing the same level of growth. But what we will expect is, given that divergence between prime and secondary, that incentives will start to tick back a little bit. And as we move through the latter part of 2020 and into 21, we will start to see some growth come through. Logistics, as you can see, Sydney and Melbourne are top pick over that time period. But one thing direct analysts can be very guilty of is telling you about the marginal transaction. So you'll pick up the AFR and hopefully you'll see me, not Tony, quoted in there, but it's probably equal in terms of the quotes. And we'll be saying something like, Melbourne effective rents have grown by 15%, or Sydney's grown by 12%, or Brisbane's done whatever. We're working very heavily on the marginal transaction. One of the key reasons for investing in real estate is longer lease terms, fixed escalations over that period. So I think you have to look through a cycle to see the impact of rental growth on what it means for potential reversion. So this rather busy graphic here shows our Melbourne gross effective rent line in the black. So that's our weighted average across the market. The red bar shows where a 5-year tenant is expiring relative to market. So if you're looking at 2016, that's a tenant that signed in 2011. They had fixed escalations in the lease. Where were they in 2016? Well, market and passing were about the same. Look at what happens for a tenant that expires in 2019. They signed in 2014. They've had those fixed escalations of 3.75 to 4%. But when their lease expires in 2019, they're faced with a reversion of 20 to 25%. And that's how that's sort of captured. So we get a lot of questions from the REIT analysts in particular saying, well, you just moved rents by X, why is that not impacted Y? It comes through the cycle, and as you can see with Melbourne, we've got a very strong reversion cycle built in, and a lot of that's been built in on the growth that's already occurred. So even if those growth rates moving forward do prove to be ambitious, there is still a reversion story. We're debating how much that reversion is. I just want to briefly touch on retail. And at the moment, a lot of the research on retail is quite frankly just very, very lazy. Everyone's view is binary towards the asset class, with more people sitting there going, it's bad, than sitting there saying it's good. I think it's important, again, to read behind those headlines. There are some centres which are dominant centres within their trade area. That trade area is growing, minimal supply risk, and doing very well. There's other centres which clearly are facing the brunt of the competitive pressures within the sector. So one of the ways that we tried to quantify this was, JLL's a large manager of retail shopping centres across Australia. We decided to just start surveying those guys every 6 months. And one of the questions we asked them is, how much level of incentive do you need to provide to a new retailer? Look at the numbers from a few years ago, back in February 2016. Virtually no one said 0, and very few said greater than 20. Look at the numbers today. The greater than 20 bit has grown significantly. But so is the other end of the ledger. Those managers that are providing 0 incentive has also increased. And it really points to me towards the bifurcation that we're seeing within the sector, and the importance of understanding where the asset sits in the hierarchy, how that asset is managed, the trade area, and the potential growth within that trade area. It's just too lazy to say retail is bad at the moment because of all the competitive pressures. So this is what I wanted to finish on. If we'd started, this is what I would have started on as well. So what are we seeing at the moment? Well, we touched on the investment markets. We touched on trying to quantify that weight of capital argument and what that means, both from a cyclical perspective and both a structural perspective. We spent quite a bit of time on the office markets, talking about Sydney and Melbourne and how strong they were. We touched on why we should read behind the headlines in both Brisbane and Perth, and also Adelaide and Canberra. And we touched on where rents are going. And then we spent a little bit of time on the logistics sector. To me, logistics is the really fun part of commercial property at the moment. This is a sector which is going through a significant evolution, significant consolidation and ownership globally at the moment. And one of the points that we didn't touch on earlier is there's a whole lot of structural reasons, but to me there's another reason which doesn't capture as much airtime. And if you look at the volatility of returns for logistics over the longer term, it tracked retail and to a lesser extent office from the early 90s through to 2007. People then discriminated against the sector through 08 and 09, and they believed it wasn't as well managed, the covenant qualities were lower, tenants were going to fall over, there was going to be rent holidays and more vacancy in the sector. The reality is none of those things happened. So when you look at the volatility of returns on a rolling average, they very quickly reverted to pre-financial crisis levels. And to me, that's part of the reason that you can start to now build in a re-rating of the sector. You've actually seen the resilience of the cash flow in a downturn. So that is a roundabout way in terms of how I wanted to touch on where we're seeing the markets, and I'll hand back to Steve.
So I'm going to change gear a little bit, but by chance, given this, the topics that we've already heard, a lot of the themes that I'm going to talk about naturally actually lend themselves to changes in the property market. Now my presentation is also very visual, so what I thought I'd do is not spend too much time on net wealth other than to say we are a wealth management platform, so we offer a number of products and services that allow investors and financial intermediaries to manage their wealth across a whole range of different asset classes and asset types, including in Charter Hall. As a business, we're extremely focused on our technology, being a technology company, and we're currently rated the #1 platform in Australia for technology. Equally, we're also extremely focused on our service and have been rated the #1 platform for service and overall satisfaction for 6 years. More importantly though, we've got a real strategy around research, and I think that's really where we're going to spend some time today. So we're a very curious business. We're constantly looking around the world, looking over in the States, looking at what's happening in Australia to try and identify, what are the mega trends that are driving society. And what I'll do is I'll just play a very quick video that'll sort of frame, I guess, the next 20 minutes or so. So I'm not sure if everyone can see the screen. If not, perhaps move around. If not, okay, see if this works.
There is no denying that the technological progress of the past 15 years is the stuff of science fiction. Devices got smaller and more powerful. Our lives became significantly more social, and the app ecosystem exploded. Every day, people appeared on the world stage, and we received entertainment on demand. We gave each other a ride and shared our castles to build an empire. Even our finances went digital. In the present days, technologies have freed our latent desire to be always communicating, changed the way we make friends, the way we express, how we buy things, and removed our borders. We store our data in the cloud so that we can access it from anywhere, at any time. As we look to future horizons, our machines are becoming smarter, more intelligent. They are helping to drive our cars and transforming supply chains. Devices are monitoring our health, learning who we are, and changing the way we explore.
And I guess the point of the video is that it's only when you compress it into a 2.5-minute video that you realise just how much everything has fundamentally changed. The way that we connect, the way that we communicate, the way that we date in some cases, the way that we shop, everything is completely different to what it was 5 years ago. I've been fortunate to spend quite a lot of time in America over the last couple of years, including about a month or so in San Francisco at different times. And it really is no surprise that the world's biggest companies, many of which are listed up on that screen, are based in San Francisco. As someone explained to me once, they said, San Francisco is to nerds what Hollywood is to actors. And that is absolutely true. And so effectively what happens is you've got a city, which is a great place to live, very much like Melbourne, great weather, nice people, working on problems that I didn't even know existed. And the difference with Americans is that they're extremely happy to share, they're happy to collaborate. And so as they solve one problem, they come up with another problem and they solve another problem. And the things that they're working on are just absolutely mind-blowing. And unfortunately, we don't have time to go into that. But some of the really key themes that have come away from those trips are, the first is that these companies have set new expectations for everyone. As a financial services business, we're no longer compared to banks or institutions, we're compared to the likes of Google and Facebook and Amazon. And why I say that is because they've set new customer expectations. They've removed friction from every part of our life. Amazon's got to the point now where they place buttons around your home next to the washing detergent, so as you run out of detergent, you simply press a button and it turns up the next day on your doorstep. They are revolutionising every single industry. And as business people, we've really got to think about that in what we do and how we really compete in that perspective. You know, they're able to deliver highly, highly personalised services to millions and millions of people to deliver exactly what you want at exactly the right moment. And that is now an expectation moving forward. I think the second point is that it's no longer man against machine. People that are successful in the future, it's going to be man with machine against man without machine. And again, we're seeing that across every industry, and it's disrupting so many old industries as well as creating new ones. And at the same time, it's creating a huge amount of jobs. It's also destroying other ones. But I think inherently humans are very creative, and we'll keep recreating ourselves and finding new things to work on. So if we look at some of the mega trends, and there's too many to talk about today, as much as I'd love to. If we think about always connected, as a society, we are always connected, and this extends to Internet of Things, and I'll talk a little bit more about that. And it's not surprising. So at the moment, around 45% of the world is connected to the internet. By 2025, this is expected to increase to 85%. And when you couple that factor, so always connected, with the immense computing power that is now available, it's not a stretch to understand why it is that our physical lives and our digital lives are going to become increasingly connected and overlap. As an example, to do a Google search uses more computing power than the whole of the Apollo space program used both on the ground and in the air. The Super Cray computer, which was launched I think in 1984, the most powerful computer in the world, had half the power of an iPhone 4. And post the iPhone 4 launch, an Apple Watch now has 2 or 3 times the power of the iPhone 4. Just gives you an idea, and we've all heard of Moore's Law. So always connected means that we're going to see things such as wearables. Who in the room has got a Fitbit or an iWatch or is tracking their fitness? Okay, not as many as my usual crowd. You will be. By 2025, and I think this stat is horribly understated, the research would suggest that 10% of us will be connected or wearing wearables connected to the internet. And that extends to a whole range of things. So if you think about wearables, activity trackers, there'll be glucose monitors, there'll be diabetic tools so that you can constantly be checking your blood sugar levels and relaying them to your phone or to another computer. And Google Glasses, they'll be wearing a lot of internet-connected glasses. Now, Google Glasses were a complete failure. I don't know if anyone ever saw them being worn in the wild in person. I saw someone once on a tram ride sitting opposite me, and it was really freaky. It was just, you didn't know what they were doing. Were they looking me up? Were they looking at the internet? Were they checking their emails? It was just weird. Subsequent to that, I think people have taken that on board and they're looking at how do we make Google Glasses or augmented reality a little less creepy. But this has got huge implications. So moving forward, things like healthcare and also life insurance will be based on these internet-connected devices. So what is your activity? What have you told the insurers? And premiums will effectively be calculated and charged almost on a daily basis. And the same can be said for cars based on the actual wear and tear and where you're driving. So it is going to really change the way that products are delivered in the future. If you take that a step further, I was talking about wearables. There's companies out there looking at actually embedding tech into our bodies. So Elon Musk, who is either a genius, crazy or both, is basically looking at how he can insert chips into our brains so that we can compete against the robots. So he's very concerned about the robots taking over the world, and he's decided he's going to solve the problem. So what this means is he's effectively trying to create the third cortex in our brain to make us superhumans. And then you'll be able to do things like download memories or dreams onto a hard drive wirelessly, and likewise upload skills that we might need to combat the robots. Like I said, he's got a pretty good success rate. He's actually almost got people to Mars. He's delivered electric cars, so who knows, it might actually happen. MindLeap is another company. I think it's just raised another couple of $100 billion or whatever it might be. They're looking at putting tech into our eyeballs. So I was talking about wearables, but by inserting a chip into our eyeballs, and this is actually getting very close, we'll be able to look around the room and again augment our reality. So be able to look up prices at the supermarket, look at ratings for particular products, be able to get a quick reference on who Cedric is and should I trust him, which of course you should. So this idea of, and also nanobots, they'll have nanobots basically floating around our bloodstream looking for illness and fighting illness, so cancer cells and different things. So again, our world is going to radically change, and I heard something at a conference the other day that would suggest if you can stay alive for another 366 days, for every year longer that you live, you will live another year. So it's a pretty good incentive to hang around for that extra day. But medical science, so if we're all living to 150, what does that mean for hospitals? What does that mean for accommodation, aged care? The implications for property are huge. Yeah, so by 2025, 100% of cars will be connected to the internet. And I would suggest that they'll also be largely autonomous. So we've already got cars that can drive themselves. We're just working through the different regulations to work out how that's actually going to occur. And what's amazing is I've got 3 kids under 3, and none of them are ever going to have a driver's license. They won't need one. So if they want the experience of driving a car, they'll have to go down to a park or the Calder Park or something and drive cars around in a loop. It's a pretty mind-boggling thing, and as a parent, it gives me great comfort because I believe that's one of the most stressful periods in every parent's life is when their kids get their L's. But that's just not going to exist in the future. And think about what that actually means then for parking. And we heard a great use of all the car parks now being dispatch centres of the future. But cars in the future are not going to just be about transport. They'll be moving offices. You can pick people up, you can have a meeting, there'll be entertainment pods. There's going to be a whole range of new things that occur within autonomous driving when you're not actually required to drive. Likewise, our homes are going to be fully connected. And already we're seeing that. I've got an Alexa at home, which is basically allows me to do things like turn on the radio, turn on and off lights. My son thinks it's hysterical, but my wife thinks it's horrible that I don't say please, so we're having to teach Alexa how to understand instructions if I say please, because at the moment she doesn't. But houses are going to be fully automated. And the implications for the workforce is that this hub and spoke model, houses are going to have the same specs as office spaces. You'll have high-speed internet. Every house will be connected to the NBN. You're going to have huge screens around your house. You're going to have incredible virtual meeting equipment. You'll be able to put on virtual reality masks and actually sit in virtual meeting rooms and interact with your colleagues in that way. So we don't know where this is going to go, but houses connected to the internet are again going to change everything about how we live. And what that means for us as a society is we need to get used to living in an omni-channel world. And what I mean by omni-channel is that we're going to be getting messages and notifications and communications from pretty much every source you can imagine. And just to put that into perspective, my mum at the moment, on any given day, I'll get something on Facebook Messenger, she'll send me a text message, she'll probably email me, and she might call me. Now, some of those things might be related, some of them can be completely ad hoc. But in any event, I have to be able to connect the dots, and I have to be able to deal and communicate in all of those different channels. And the reason that she's doing that is because she'll read an article on Facebook, and the easiest way to share it is just to hit share. So people will live in different environments, and we need, as a society, to work out how we're going to deal with it. We've distracted enough as it is. Artificial intelligence is the obvious other big mega theme, and it is big. Again, in America, you drive through Silicon Valley, San Francisco, even New York, and every second billboard is effectively talking about artificial intelligence. Back in 2010, venture capital invested around $10 billion into AI. They saw, this is a technology that might take off. Fast forward to 2015, there'd been $45 billion invested into artificial intelligence. And so whilst our devices at the moment listen and learn, you've got things like Siri, Cortana, and other virtual assistants, it's actually considered AI to be pretty dumb. So if you think about the fact that it can also translate any language and you can hold a conversation with someone that doesn't speak English, the fact that AI and Watson are able to diagnose disease better than any specialist, and you're able to drive a car from America all the way across the country to San Francisco, that's using dumb AI. So fast forward 2 years, and that's when they start to think it's going to get smart. The mind starts to reel again as to what that actually means for society. There's a video going around at the moment on the internet, some of you may see, of Google's new artificial intelligence service called DEXA. And basically DEXA sounds like a human. DEXA can ring up and organise a haircut or book a hotel or make a reservation at a restaurant for you. They were demonstrating it, and effectively the person at the other end, so the hairdresser or the restaurant, had absolutely no idea they were talking to a robot. And they'd even gone as far as to insert things like ums and ers to make it a natural experience. And they were able to check the person's calendar, book it in, check rates and all those sorts of things. It is really incredible stuff. But again, we've got to start thinking about what are the societal impacts of some of this research, or some of these things. One of the things that AI is very good at, and you'll see that in a couple of slides' time, is investing. Now, I think no one's quite ready to put all of their money with an AI-driven investment program yet, but let me just talk about this particular example. So I spent a bit of time with a company called Sanlam. They manage around $104 billion globally. So they're a pretty serious investment house, and they're rolling out AI investments in a major way. This particular model basically works on 3 steps. The first is they input the data or the time series that they're wanting to look at. They then run the simulator, and I'll talk a bit more about that in a moment. And they basically, each robot, and there's 600, for every asset class, they've got 600 self-learning AI analysts. So sorry for the analysts in the room, but they've got 600 of them for every asset class. And every one of those analysts is self-learning, and they're looking at different statistical models, they're looking at different time frames, and they're basically making predictions. You then have an asset class manager who takes the best 30 predictions from that group of 600 and feeds them into a portfolio allocator. That portfolio allocator, which is also an AI robot or AI analyst, then takes the best predictions from all of those different asset classes and builds out a portfolio based on your particular risk or requirement. So in this case, it's a balanced portfolio. So in this case, you've got, I'm going to get my maths wrong here, 2,400 AI analysts building your portfolio for you. Now the beauty about an AI analyst is you don't have to pay them, they don't take sick days, they don't have academic debates, they just give you the data that you need to know. And the returns have actually been quite staggering. So this is real money being invested. And as you can see, the returns from the AI portfolio are 4 times that of the natural human Morningstar Balanced Index. Now what they're trying to do here is to actually minimise your drawdown, so they're not just trying to blow out the lights, they're trying to reduce the drawdown in times of volatility, but also obviously grow the portfolio in the good times. So I think this is something that's going to grow really quickly. It's sort of the next evolution of quant management. We're certainly hearing a lot about index management. This is where the industry is heading. If you can get your head around a robot managing your finances and building your portfolio and managing your money, the next step is Penny. So Penny is an AI-driven financial coach. So Penny takes in all of your banking data and all of your sort of information about you and makes recommendations on a daily basis and basically tries to coach you to a better financial position, whether that be retirement or just day-to-day budgeting. It'll also look at services that you use. So if you're on Foxtel, it'll look at Stan and make sure that you're getting a good price. So it's got all the comparisons engines built into the background. And effectively every day it's just looking at your data and just coming up, with more and more ideas on how you can save money, become a better investor, and ultimately live a happier life. So they're just 2 really big mega themes that I think are incredibly exciting. There's heaps of other stuff, as I mentioned. Some of the ones that you might want to look at in your own time. We've talked a little bit about robotics, 3D printing. Really exciting, and this again potentially completely disrupts the whole logistics industry where you can just print off the products you want at home. And don't just think about printers as printing off static objects. When I was over in Austin recently at South by Southwest, there was a stand there where effectively they had their colleagues in Japan, and their colleagues in Japan were sending messages and they were printing sushi. And it tasted exactly like you would expect it to. So what they're able to do is not only replicate, and it's a bit gross when you hear about it, they basically flavour yeast, but they effectively can replicate the taste of most food these days. But also imagine the scenario where you walk into a restaurant, they prick your finger, quickly work out what you're deficient in, whether it's iron or something else, and in addition to printing the food that tastes good, they're also printing in the different nutrients that you need to make sure that you're fitter and healthier. So these are the sort of things that are going on, and where this is really exciting is there's all these different tech platforms at the moment. Individually, they're fascinating. Where it gets really, really fascinating is where all these different tech platforms start to collide and there's an intersection of different ideas. So 3D printing with artificial intelligence or robotics. I can never say this word, genomics or genoomics. Some of you may have started reading about CRISPR or the ability to basically edit DNA and remove sickness. Again, all of these things are living to a longer life. Transportation and smart cities, I think we've talked about, but the way that cities are constructed and built, the idea of working from home and using this sort of hub and spoke concept is only going to be amplified. And blockchain and crypto, I just don't have enough time, but other than say, blockchain really is going to change the world more than the internet has. If you think about where the internet was 20 years ago and how no one actually understood what the use cases of it were, that's where blockchain is now. And already at very infancy, blockchain's being used to solve refugee crises where people that historically had absolutely no identity are now able to have an identity as they move from camp to camp to camp. They're able to record their education, they're able to record their background, their family members, and also if they've been trading cocoa beans between each other. So that's a really fantastic use case. And likewise for transportation and supermarkets, they're able to track back to the source where individual carrots have come from, even though it may have gone through 20 or 30 different points of call, so that the outcomes of that are significant and would have avoided the spinach shortage in America, which nearly sent the spinach industry broke a couple of years ago. So it's an exciting time. We're all going to live a lot longer, that's the good news, but we've also got to be aware of just how it is going to impact on our investments and also some of the things that we're thinking about today. So that's all I've got time for today. Thank you very much, hope that was interesting.